As the US presidential race tightens, investors are staying bullish, driving the US stock market to new heights. The S&P 500 has surged 22% this year, hitting almost 50 record highs along the way. That's as the artificial intelligence boom drives huge gains for the so-called Magnificent Seven, the name given to a group of high-profile tech companies. Shares of Nvidia, Meta, Amazon, Microsoft, Alphabet, Apple and Tesla make up more than half of the S&P 500's year-to-date gains. But the market's unusually high concentration around a few big tech companies is now putting fund managers in a tough position. Major investment funds like Fidelity and T. Rowe Price are now being forced to offload some of their holdings as the market rally has pushed them close to limits set by market regulators in the US. The Internal Revenue Service requires funds to keep large holdings, anything over 5% of assets, below 50% of their portfolios. While exceeding this limit due to price gains alone isn't penalised, maintaining regulated investment status is crucial for tax benefits. Losing it could severely impact fund performance, with frequent rebalancing and potential capital gains taxes cutting into returns. Well, let's get more on this now with Dennis Kenji Kipker, his Research Director at Cyber Intelligence Institute. Great to have you back with us, Dennis. The S&P 500's impressive rally this year really has been driven by just a handful of tech stocks. Do you see this narrow concentration as sustainable, or could it pose risks for the broader market?
Yeah, in my opinion, the concentration of these S&P 500 rally is really dangerous and could cause definitely a concern for several reasons. So we have, on one hand, increased volatility. So where just a few stocks drive the market, the performance becomes highly influential, leading to greater market volatility. And a downturn in these stocks could also trigger a broader market decline. And we have also certain valuation risks. So some of these tech stocks have seen significant valuation increases, raising questions about whether their current prices are justified by future earnings potential. So if investor sentiment may shift, these stocks could experience sharp correction. And last but not least, we have a lack of diversification, which is always dangerous. So a concentrated market reduces diversification benefits. Investors relying heavily on a few stocks are exposed to increased financial risks here.
Now, one significant event that could sway the markets is, of course, the US presidential election, which is happening in about 9 days' time. How much of an impact will that have on stocks, do you think?
It might be possible that it has an impact. So we have several reasons here. One, I mentioned before, is increased volatility. But the second one are also geopolitical tensions. So we have geopolitical tensions and economic uncertainty. And these both can lead to increased market volatility as well. And this could cause sharp swings in stock prices, especially for tech stocks, which are often more sensitive to changes in investor sentiment. And there's also a still open question of the supply chain protection also in the United States. So this global conflict could also disrupt certain supply chains, impacting production of tech components and devices. And it's currently not clear how it will be politically solved. And this could also lead to shortages, higher prices, and possibly slower growth for tech companies. And last but not least, it's all about investor sentiment. So negative news and uncertainty, politically speaking, can dampen investor sentiment, leading to a sell-off in tech stocks. And this could be exacerbated by concerns about the potential of this outcome of the further elections.
Another driving force behind tech stocks, of course, are earnings. We're expecting more big tech earnings this week and in the coming weeks. To what extent do you think they might continue to drive this tech rally?
I think the earnings are of relatively high importance here, but we see several issues that are also important. So we see increased selling pressure. We see at the moment reduced liquidity and also the potential for market correction. So we really have some overcrowded positions here. And when a stock becomes heavily concentrated in a few large funds, as I mentioned, it creates a situation where these funds may need to sell a significant portion of their holdings to adhere to diversification rules, and we have to consider the market impact as well. So the sudden influx of selling pressure can drive down the risk, the stock price, even if the underlying fundamental remains strong. And this is all things that are connected to the problem of these reduced liquidity, which comes to market death and price volatility as well.
Okay, Dennis, Kenji, Kipker, we'll have to leave it there. Thanks as always for joining us on the program.
You're welcome. Thank you.
To Nigeria now, where more men are challenging traditional gender roles and breaking into the female-dominated beauty industry. Kalechi Emekalam caught up with one of them who's holding his own, making bold statements in a culture where career paths can be limited by society's expectations.